Good evening, investors. This is Jim from Evergreen Capital Management. I'm doing a little webinar today showing a strategy designed to reduce volatility in a very volatile world using an idea I call trigger management. What I've done is I've assembled 20 years worth of stock market behavior here. This is the S&P 500. Recall that the 500 is the largest 500 domestic corporations. Many have multinational exposure. These are companies that are large enough that I'm sure you've heard of most of them. ExxonMobil, IBM, Microsoft, Procter & Gamble, you name it. Anyway, we've got a history here that shows in 1990, 1991, we had kind of a step ladder up and down. 1994, we had the very classic horizontal consolidation mode. Very tight, narrow band, a lot of horizontal behavior. You can see with a bunch of the red indicators here, we had significant downtrends there. And of course, we had the 5 years of the internet boom. This is where anything with a .com in its name went to the moon, and it dragged a lot of America with it, like Disney and Procter & Gamble and IBM and all the like. Subsequent to that, we of course had the tech wreck, which was from March of 2000 all the way down to August 2002, where the market scrubbed off 50% of the index value. Had you invested $50,000 at the top, your account would be worth about $25,000 down here. Exactly the reason people love the stock market, but also look at it with very squinty eyes. You better be savvy to deal with this volatility. Then, of course, we had the recovery, which to me is very interesting in that the recovery peak double topped right at the previous peak, and I'm myself as a technician am looking forward to the triple top a couple years down the road. After the tech recovery here, then we had the mortgage meltdown, the subprime financing crisis that bled right into a global recession. This is the second worst drawdown since the stock market crash of 1929. $100,000 portfolio at the top invested would look like $42,000 down here. Not a pleasing picture if you're a new investor. But currently we're living comfortably above an uptrend line, although we are clustering this year, much like we clustered in 1994, consolidation phase, where we're basically deciding if we want to spring off the trend line upwards, or if we're going to break through the trend line and head down. Either way, I've developed a strategy called trigger management, which is going to take advantage of all of these big, huge trends. The idea is to build a mathematical smoothing algorithm that smooths the data. And what we try to do is use the trigger, which is the gold line here, to indicate what we expect. Here we expect the market to bend down. Since the trigger's bending down, we have a bearish mode. With the trigger going up, we have the expectation of a bullish market. Trigger bends down, we look bearish. And of course, when the trigger moves up, we have a very bullish market. We stayed bullish for 5 whole years here. Very, very strong uptrend that you don't want to wreck with any trading. And of course, you had the top and the eventual bend down in March of 2000. And we had the rally. Then of course we had the the mortgage meltdown. And we're now in a buy mode right now. So you can see that there's a strategy takes advantage of all these dedicated uptrends and downtrends, recognizing that when we cluster, when we go up and down, much like we're doing this year, this strategy has less strength to deliver into your account value. But recognize that in a consolidation or in a clustering or in a horizontal market, you're not going to make any money anyway. So it's not like you're leaving anything behind. Now, let's take a look at what that would mean to your rate of return. You invest to get a return. So let's see what happens. Let's take 20 years of the stock market and pretend like it's a 20 different one-year CDs starting January 1st and going all the way to December 31st, and stack them together like a stack of 20 coins, like 20 silver dollars on top of each other. You can see that in the first 5 years we got we got fairly reasonable stock market behavior, strong double digits. That's what you expect with the occasional weak year. Here we got 5 years of overperformance. Everybody knew it. Everybody loved it. We knew it was going to come to a head. Well, it came to a head, and we ended up with 3 down years. This dedicated downtrend did a lot of damage to a lot of account values. We've got this very sporadic recovery. It took about 5 years to recover from the tech wreck, and we walked right into a mortgage meltdown, a subprime finance crisis, and the global recession. The reactionary up, and now we're sitting on this 1-year 2010 cluster. Basically, we're just going sideways this year. We're doing some ups, we're doing some downs. I think we're ready to do a little bit of up here now. In the meantime, if you were a Rip Van Winkle long-term investor that was a buy and hoper, where you bought back in 1990 and went to sleep under a tree for 20 years, woke up in 20 years, you could say, well, darn, I got an 8.6 average rate of return per year, which is not so bad. Not so crummy, but it's not so bad either. What you didn't know in those 20 years since you were asleep is the amount of volatility was just pretty outrageous. Meaning, if you statistically add your average rate of return plus and minus your standard deviation, that gives you an expectation of a 67 percentile expectation where you think the next year is going to be. Meaning, over 20 years of data, the next year is going to be probably contained within the plus 27 top end and the minus 10% bottom end. And you can see that most of the data has fallen inside this one standard deviation calculation. Well, you've got overperformance, you've got underperformance, and the whole point of the strategy is to deliver a reduced volatility. What can we do to improve that? Using trigger management, we can we have actually improved our rates of return. These are the 20 years in the S&P. This is the rate of return you'd expect out of a managed trigger account. In the uptrending years, your performance is superior. In the downtrending years, you're able to take advantage of that dedicated downtrend and actually deliver a couple of strong years. In the haphazard ups and downs, you still did pretty well. The key here is if you can turn a minus 38% return into a plus 20% return, this 1-year performance will pay for the entire 20 years of pain, suffering, management, supervision, annoyance, time, energy, fees, costs, commissions, whatever the strategy cost you in overhead, this year here paid for the whole darn shooting match. The weakness of the strategy is, of course, it does well in trending markets. It does not do well in clustering. And in '94, we clustered, gave some money back to the strategy. And this year, 2010, we're clustering. We're giving a little bit of money back to the strategy. How does it look when you compare the old to the new? If you're a Rip Van Winkle guy, you'd get 8.6% average rate of return per year. If you were a trigger managed account, you'd improve that to 10%. Don't forget, we're not here to try to outperform the market. The whole point here is to reduce volatility. And with that, we can redo the standard deviation and reduce it from an 18.8% to a 17.1%. So if this strategy using trigger management gives you a 1.4% rate of return, that's good. And it reduces your standard deviation volatility by 1.7, that's good. And if we can take these dedicated downtrends and convert them into uptrends in your account, that's good. The only negative is if we cluster, we have to give something back. But like I say, we're in a horizontal mode anyway when we're clustering. You're likely not making money anyway. So it's a reasonable strategy. What does this do? It gives us a chance to change our gridiron from the plus 27% we got last time. But here, our bottom side gridiron is minus 7 instead of the minus 10%. So anybody that can give you a 3% improvement in your bottom gridiron, that can get you a better rate of return, that can reduce your standard deviation, that can actually take you out of the market when we've got dedicated downtrends, this strategy is worth its weight in gold. What does it look like in your account value? Well, if you were a long-term Rip Van Winkle buy and hoper, you'd be making money for about 10 years, then you'd give some back, then you'd be making some money, then you'd give it back, and then you'd be making it. Essentially, you'd end up with that 8.6 average rate of return. But using trigger management, which is the blue line, you can see that your account is going to be a little bit more robust when you have dedicated trends. When you got this dedicated downtrend, you're still making hay in the market. When you have an uptrend, you're still moving up. When we're moving down in a dedicated downtrend fashion, we're still making money. Don't forget the weaknesses in the horizontals. We give money back to the market. We're clustering a little bit this year. We're giving a little bit of money back to the strategy. Can't have it both ways. Can't have your cake and eat it too, so to speak. So what does the trigger management do for us? First, it reduces our volatility, which is the entire purpose of the strategy. Number two, it does give you an incidental increase in rate of return. It takes advantage of volatile trending markets. So when the market is dedicated in an up or dedicated in a down mode, we can take advantage of it. Keeps you on the right side of the market, gives you a sleep comfort factor. Don't have to be waking up at night worrying about your money. The disadvantages are fairly minimal. You will whipsaw on small losing trades when you have the clustering, the consolidation, the horizontal mode. It does require daily supervision, but that's my job. I'm watching the indicator, the S&P, and this trigger management strategy daily. Does not do well, like we say, in the clustering markets. And it does require a execution of a buy order when the trigger moves up and a sell order when the trigger moves down. But that's what my company does anyway. So all in all, it's a great strategy for retirement, for long-term investors, for the 401k people, 403b for the 457, and for those people that want to have a strategy that reduces all that volatility out there. Thank you for your time. I'm Jim Bent, Evergreen Capital Management. The EA is all about enrolled agent. That's a tax expertise. RIA is registered investment advisor, expertise in investments. I appreciate your time. Give me a call if you're interested in talking about managed accounts and managing a trigger management strategy for your retirement account. This is Jim out.